Good afternoon, everybody. Welcome back to another episode of the Fit Finance Sessions with myself, Tim Webb, and my colleagues Henry and Tom. Just briefly following on from what we were chatting about last week with regards to Bitcoin, there's been a bit of a shift over the weekend. Well, rather than me blabbing on, does one of you guys want to take the reins and tell everybody what I'm talking about?
Yeah, happily. I must confess that I have disclosure. I have an interest in the Bitcoin market at the moment with a very small holding. So Bitcoin volatile. We spoke about this last week. It goes up and down like a yo-yo. Over the weekend, it went up to $42,000 a coin. And when I woke up this morning, it had plummeted by about 15% down to about 32, and I think it's now gone up a little bit back to $35,000 a coin. I think the thing to say is just as we just discussed last week, it's another asset class, and there's no harm in holding some Bitcoin to diversify your portfolio. But it is a very, very volatile market that is not regulated by the FCA and all that sort of stuff. So if you're invested, expect a volatile ride. Hopefully there'll be some decent profit out of it in the longer term, but in the shorter term, hold on to the seat of your pants. The other thing, actually, Tim, that we were discussing about before we came on this call was how it seems to be very closely linked to the gold price. I'm not sure if we touched on that last week, but it does, because I think gold has fallen off a little bit this morning as well, and it does seem to be that they're creating quite a close correlation between these two asset classes and some of the other precious metals as well. And I guess it'll be interesting over time to see if that remains, or whether or not actually Bitcoin breaks free of it. If we're heading towards a slightly more certain future, you would expect the price of gold possibly to fall away a little bit. It tends to be a place of security. So in uncertain times, people flock to gold. But if some of the reports reckon Bitcoin could go towards $50,000 or $60,000 a coin, it'll be interesting to see if they make that disconnect at some point. Don't know the answer there.
I think some of the issues, or some of the reasons why people are looking for these other safe haven assets are is because bonds are so. If you look at what real term returns you're going to get from bonds in the short, medium, long term, they're not going to be particularly great, and you're probably looking at negative returns. And you've probably seen in the last year that there's been more correlation between bonds and equities where they both fall. So I think people are definitely looking for safety outside of equities, looking to diversify, and I think that's bringing sort of these asset classes to the fore. And I think there was also an article about infrastructure and the Nest pension scheme moving from sort of, I think they have about 8% in private assets or infrastructure assets, and looking to increase that to maybe 15%. And because Nest is a government funded scheme, then there's pressure on them to kind of back government spending projects. So I think there's definitely other asset classes to kind of look at as part of a diversified portfolio, at least.
Yeah, exactly. Yeah, it seems to be establishing itself, going back to Bitcoin, as sort of a digital safe haven asset, in the same way that obviously gold is the most familiar safe haven asset, isn't it? But as Henry says, who knows, and nobody knows whether or not that's going to be the case. But nevertheless, institutions have been buying up a lot of it, which, if the professional money is doing it, then that there's definitely some weight behind those sorts of moves. Okay, so moving on. Obviously, new calendar year. Of course, we are approaching the end of the tax year, aren't we? Being the beginning of April. So, what sort of things should people out there be thinking about with regards to preparing for the end of the tax year, particularly allowance wise?
I think I'll speak for all three of us that if you're thinking about doing pension contributions, please speak to us now. Don't contact us on the last day of the tax year trying to get things through. It will help with our sanity. So if you are thinking about using your allowances, or you've had a really good year at the office despite the pandemic, then speak to us now about doing pension contributions and getting everything aligned ahead of time, rather than we're grey enough as it is working in finance, and and trying to hold on to our hair and the colour of it certainly is a priority.
Yourself.
Yeah. Speak to us sooner rather than later, please.
I quite agree. It's probably worthwhile just running through the allowances just so everyone remembers, because of course pension rules changed early in this year, which pension allowances tend to change quite frequently, given the fairly generous tax benefit that you get from them. But as it stands, for most individuals, you can make a £40,000 gross contribution towards your pension. And to do so, if you're making it from your net income, you'd contribute. I'm always going to get this wrong. Is it 32,000? Then it gets grossed up to 40.
It is.
So you'd contribute £32,000. That gets grossed up to 40. And if you're a higher rate taxpayer, then you'd collect £8,000 to £10,000 back on your tax return as well. As I say, you've got your £40,000 for the year. If you haven't used your pension allowances from the previous 3 years, there's a possibility of carrying that forward to maximise the contribution that you make in a given tax year. And the other thing to say is that there's a taper which starts to reduce the contributions that you can make for higher earners. So if you earn over £210,000 in salary and pension contribution, then it's worthwhile getting in touch, and we'll work out exactly what you can contribute this year, because your allowances will start to be tapered over that sum.
Okay, smashing. So pension allowances. What other things should people be thinking about?
I think there's always the ISA allowances as well, and lots of our clients will be selling assets out of their unwrapped investments, and therefore, particularly with markets, some funds have been winners, some funds have been losers, just triggering any capital gains or any capital losses, and making use of the exemptions there as well.
Okay, yeah, that's right. So just to put some numbers on it, £20,000 per person per year can be placed into an ISA, whether a cash or an investment one. And on the capital gains, every individual's got a £12,300 capital gains tax allowance this year. So if you've made some profits, and certainly some people have made profits, as Tom says, in the second half of this year, it might be worthwhile taking some of those profits, using your CGT allowance, and then reinvesting into similar style funds. And we will help with clients who have unwrapped portfolios. We'll do our CGT harvesting bit a little bit closer to the tax year end. But if you've got some others, it might be worthwhile getting that all done and dusted now, and then letting us know so we know to take that into account.
Yeah, absolutely. I think it's worth mentioning both on those last two, ISA and CGT allowances. Of course, they're provided on a use it or lose it basis, aren't they? So if you don't use them, then there's not the ability to be able to carry them forward. So it's definitely worth doing if you're able to. Fantastic. Right. Well, has everybody else got anything else to add, or I think we're pretty ticked off for this particular session?
I think I think that'll cover us for this week. Stay tuned for the next exciting episode.
Yeah, indeed.
Outside chance, we might even have a mortgage advisor joining us next week, I believe.
Yes, indeed. And of course, the MD himself, Mr. Charlie Redding.
Stay tuned.
Indeed. Yeah, lovely. All right. Well, thanks very much for listening. And yeah, as the guys say, stay tuned. Bye-bye.